Hello, Accounting 2 students. Today we're going to talk about Chapter 19, Section 1, the ownership of a corporation. And what we're going to learn in Chapter 19 is which equity accounts are used in corporation accounting, how equity is earned through business profits, and how it's reported. And we're going to talk about which end-of-period financial statements are prepared for a corporation. We're going to talk about a couple new accounts today, the first one being capital stock. Capital stock represents the investments in the corporation by its stockholders or owners. Now, stockholders or owners of the corporation can range anywhere from one individual owning 100% of stock to thousands of individuals owning smaller percentages of shares within the corporation. All right? The account capital stock is classified as a stockholders' equity account as opposed to the Accounting 1 days where we had owner's equity. Now we're using stockholders' equity. Back in Accounting 1, when we were talking about a sole proprietor, we used owner's equity. And with the owner's equity, we talked about the capital account, or the individual owner's capital account. In this case, Maria Sanchez capital. We increased the capital account with a credit, decreased it with a debit, and of course our normal balance was on the credit side. Capital stock is done the same way. All we are is replacing it with stockholders' equity. Capital stock is going to be also increased on the credit side, decreased on the debit side, with the normal balance on the credit side. Now let's take a look at a transaction, and let's think of how we would put this into a T count, and further how we would journalize a transaction. So on January 1st, stockholders invested $25,000 in exchange for shares of stock of the corporation. Receipt 997. So again, how are we going to put this into T account form? Well, cash in bank, an asset account, is going to be increased with a debit of $25,000, and capital stock, the stockholders' equity account, will also be increased with a credit this time of $25,000. Okay? Now, how do we go ahead and journalize this transaction? Again, back to our Accounting 1 basics, we're going to go ahead into our journal. Since this is the first line of the journal, we're going to go ahead and put in the year. Okay? Next line, we're going to go ahead and put in the month and the day. Okay? We're going to put our debit first, as always. We're going to align to the left. Cash in bank is debited, $25,000 in the debit column. We next move on to our credit. Our credit is capital stock. We indent our credit, capital stock, and we go ahead in our credit column and we put in $25,000. In the last line, we need to identify our source document. It happens to be receipt 997. We're going to further indent our source document to identify where do we get this information from. And that completes our journal entry. Stockholders' equity, where does it come from? Well, the equity or the cash or the investment by stockholders is where it happens, as well as the profits that we generate through the business and that we retain through our company. So retained earnings is the next account that we are going to be talking about. And retained earnings represents the increase in stockholders' equity from the portion of net income that we keep in the business that we don't distribute to stockholders. In future chapters, we're going to talk about the portion of net income that we distribute to stockholders. That is called dividends. But for now, all we're going to talk about is what we retain in the business, and we call that retained earnings. Retained earnings is also a stockholders' equity account. We're going to increase retained earnings with a credit. We're going to decrease it with a debit, and naturally, our normal balance will be on the credit side. As we get ready to prepare financial statements in the next sections of this chapter, let's talk about the balance sheet and its preparation. When we did the sole proprietorship balance sheet, we had an owner's equity section, and we had one account essentially in there, and that was the individual capital account, or in our case, Maria Sanchez capital. With a corporation, we have a little different where we have the stockholders' equity section, and we have two accounts represented there. We have our capital account, and we have our retained earnings, which we had just gone over. Moving forward, who uses financial statements? You should be able to answer this question from Accounting 1, but let's review this real quick. Managers. Managers of the business use the financial statements to help them evaluate the past and the performance that they had, as well as to help them make informed decisions going forward. Stockholders are interested in the performance and the potential future growth and the success of the business to whether they want to continue to invest or maybe get out. Okay. Creditors. Creditors also want to know before they do business with you, any debt that you incur, you're going to be able to pay your debt. Your financial statements will let them know that. Government agencies like the IRS want to know what's going on with your business so they can collect the correct amount of revenue from you in taxes. Your employees, certainly your employees, will hopefully want to know so that they can continue to do a good job for you and the corporation and improve the bottom line. Consumers, before they go make purchases, want to know, is this company going to be around? They want to know that they're dealing with good quality companies. All right? So these are all parties that are interested in the financial position of the business. All right, so let's talk about the characteristics of financial information. There's going to be 5 key areas where we need to focus on when we put financial statements together. For accounting information to be useful, it must be understandable and comparable. Thus, for the financial reports to be useful, the data must be presented in a way that lets users recognize similarities, differences, and trends from one period to another. Now, the 5 areas that we need to focus on are comparability, okay, reliability, relevance, materiality, and full disclosure. Now, to try to remember these 5, I've come up with some sort of an acronym here, all based on the first letters of these 5 characteristics. So I call it C, RE, RE, MA, FUD. C for comparability, RE for reliability, another RE for relevance, MA for materiality, and FUD for full disclosure. Let's talk about these 5 characteristics, starting with comparability. For accounting information to be useful, it must be understandable and comparable. Comparability allows accounting information to be compared from one fiscal period to another, essentially the matching principle that you learned in Chapter 8 of Accounting 1. Next, you have reliability. Users of accounting data assume that the data is reliable. That is your responsibility as a professional in the accounting field. Reliability relates to the confidence that users have that the financial information is reasonably free from bias and error. Okay. Next, we have relevance. Not all information about a business is relevant to the financial decision making. Relevance means that the information makes a difference to a user in reaching a business decision. So you only want to include the relevant information from a financial perspective into your financial statements. Okay. Full disclosure. The word to disclose means to uncover or to make known. Full disclosure means that financial reports include enough information so that the report is complete. And the last one is materiality. If something is material, it's important. So we need to include that. So materiality means that the information deemed relative and material should be included in financial reports. And as a reminder, I want to let you know that you need to use Quizlet to understand the key terms in the chapter and to help prepare for the Chapter 19 test. The 5 key terms we just went over, comparability, reliability, relevance, full disclosure, materiality. Also, we need to include retained earnings, stockholders' equity, and capital stock as our key terms. Good luck studying and good luck with the Chapter 19.